We do a lot of tax planning here, specifically how to capture opportunities and avoid tax surprises. Well, when it comes to paying in taxes, is there a unique tax strategy that fits for you? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, if you are working for the man and just drawing a paycheck and there's not a lot of other unique things going on your tax return, then typically you can structure your withholdings from that paycheck to cover your taxes, and it's fairly straightforward. There's not a lot of complexity there. Now, there's a lot of tax planning ideas. Should you contribute Roth or pre-tax? Are you making sure that you capture all of your tax credits and all of that sort of stuff? So there's a lot of tax planning that's involved, but once you figure that out, once you sort through that, then your taxes are going to be paid through withholdings from your paycheck, and you've just got to set it up so it's the right amount, and that's essentially it. But if you've got more going on your tax return other than just drawing a paycheck, then you might have to figure out, well, where should I and how should I pay in my taxes? Do I increase my withholdings, or do I have to pay the dreaded tax estimates? And the IRS, basically, they want the income. They want you to pay in your taxes throughout the year as you earn the income. Throughout the year as you earn the income. And I know there's structure to that and there's rules and so on, but in essence, that's what the IRS wants. That's what they expect, that you're paying taxes throughout the year as you earn the income. And if you're doing withholdings, okay, so there's two ways to pay in your taxes. One is through tax withholdings. And that's withholding from your paycheck, withholding from Social Security, withholding from an IRA withdrawal, something like that. Any withholding is deemed or is considered to be paid throughout the year. That's the IRS. So the IRS doesn't look at, well, when did you withhold those dollars? What month? What paycheck? They just consider all withholdings as withheld and paid in throughout the year, which meets their requirements or their expectations. Whether you did actually withhold your taxes from each payment, each paycheck, or each IRA withdrawal or Social Security, or if you paid it all at once. You took one withdrawal and withheld a lump sum amount. Again, if it's a withholding, it's considered paid in throughout the year. That's just how the IRS has structured it. So withholdings, that's one way to pay in taxes. Quarterly estimates is the other one. And I said earlier, those are sort of dreaded. I have yet to meet someone that actually likes doing quarterly estimates. Now, many of you are in a situation where you have to. And if you have to, then you have to. I'm going to share a unique strategy that might make sense for you, but if that strategy doesn't make sense for you, then you've got to, buck up and do quarterly estimates, and you've got to overcome these challenges. But most people, the reason why they don't like doing quarterly estimates is because it's unknown, it's unclear. They don't know exactly how much to be paying in. And you might say, what are you talking about? Every year when I do my taxes, I'm given my quarterly estimate amounts. I know those are quarterly estimates based on last year. And if you have any unique circumstances or any changes in your financial life, then those estimates last year are really not helpful this year. So if your dividend income doubled, or you sold a rental property, or you have a lot of capital gains, something like that, then those estimates should adjust to account for it, to account for those changes. Otherwise, you're going to have a tax surprise. And when will you find out that tax surprise? In March or April of next year. So you'll have to pay the tax surprise at the exact same time you've got to pay your first quarterly estimate for next year. And so that double whammy is very, very uncomfortable, okay? And so that's the second reason why people don't like quarterly estimates is the timing of which they need to be paid. April 15, and then 2 months later, June 15, and then 3 months later, September 15, and then 4 months later, January 15. So that schedule doesn't really make sense. And when you owe taxes for last year in the spring and then have to make your first quarterly payment, that double whammy, I have lots of people that say, yeah, I'm not able to make my first quarter estimate. I'll have to double it up in the second or make one in the third, and it's just uncomfortable. All right, so if you've got a unique tax situation where you've got extra income beyond just normal kind of paycheck money, whether that's Social Security or whether that's IRA, something like that. If you've got unique income coming in, and you've got to determine what's the best way to pay your taxes to avoid or to help manage those challenges with doing quarterly estimates. One strategy you may want to consider is the 60-day rollover tax withholding strategy. Now, there are some challenges with this one too, and I'm going to explain that next, but here's in essence the idea, and I just dealt with this with a client that I served. She has had a rental property on the front of her property for years and years and years, almost 40 years. And she's getting to the age where, listen, I just can't maintain this thing anymore, and the value of it has increased. I'm just going to sell it. I like the current tenants. They want to buy it. I'm going to sell it to them. And when she did, she's been depreciating this property. She bought it a long time ago, so her cost basis was really low. She's been depreciating the property, and she sold it for a good number, a higher number than what was expected. And so right at that time, and it happened, that sale happened at the end of August. So we had just a couple of weeks to quickly calculate, all right, what should your estimated payment be, and then write a big check. And that was just uncomfortable because there were a lot of other moving pieces as well. And so instead, what we did is we did a full tax analysis, tax projection, and determined, all right, how much tax should be paid in. And it was about 45 grand federal and about 10 grand to the state is what we needed to pay in. So what we did is we took a $55,000 IRA withdrawal, and we sent $45,000 of that in withholdings to the federal government and $10,000 of withholdings to the state government. So we took an IRA withdrawal, 55 grand, and just withheld all of it for taxes. And then we had her take from the rental house proceeds, we had her take $55,000 and contribute it back to her IRA. Basically, the money came out of her IRA, and then that exact same amount of money went back into her IRA within the 60 days and was a 60-day rollover. So that withdrawal, that money that came out of the IRA, is not a taxable event to her because she put the money right back in her IRA within those 60 days. But also, the money that did come out, it went towards taxes via withholdings. So it was considered to be paid in all throughout the year, not just in a particular quarter, and therefore it kind of met the IRS criteria for having enough paid in and paid in the right way. And we just delivered her tax return. We ended up having more withheld than what was necessary, and there was no tax penalty for paying it in at the wrong time. So the strategy, in essence, worked out perfectly. Now, when's a scenario where it might not work out perfectly? And that is if you're needing to do another 60-day rollover from any other account within a 12-month, within a 1-year time period. They changed the rules recently, a few years ago, so that you can only do one 60-day rollover every 12 months. And it's, once a year, but it's not calendar year. It's every 12 months. And so therefore, you'd only want to do this strategy, consider this strategy, if you knew you weren't going to need to do another 60-day rollover at any point in the next 12 months. If so, then considering this 60-day rollover tax withholding strategy may make a ton of sense. Work with your certified financial planner. I've shared with you that your CFP should be, their fiduciary, they should be doing comprehensive financial planning, looking at all 6 areas of your financial life, and they should be bringing clarity, confidence, and creativity to your overall financial situation. Clarity and confidence that you know where you stand, that you're doing the right things, that you're on track for your goals, and then creativity, and this is an example of that, on ways for you to accomplish things financially or avoid certain challenges or pitfalls or mistakes that you otherwise might make. So work with your certified financial planner on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.